Okay, this video goes over the revenue recognition complication of multiple element arrangements. Here's a picture of what that is. So this is we're going to pretend we're the company, and this is our customer. Our customer is paying us, the company, a single selling price. But the product that we're giving to the customer has multiple elements. You see those two arrows? That's multiple elements. And those elements have different performance obligations. Okay, this is a bit of a complication for revenue recognition. So in bullet point form, if your company sells a product that has multiple elements, and the elements have different performance obligations, you have a multiple element arrangement. And here's how you do the accounting for that type of arrangement. Step one, take a look at your product and identify all of the different elements in the product. Step two is the tough one. Step two is you need to allocate the total selling price among the elements. So you need to make sure to allocate the entire selling price, and it sometimes takes estimation because many times the elements of the product, we don't really know what they're worth on their own, but we know what they're worth all packaged together. That's the total selling price. So many times, step two here, allocate the total selling price to the elements, takes a bit of management judgment and estimation. But once you've completed step two, step three is to determine the performance obligation for each element. And finally, step four is to recognize revenue for each element as you satisfy that element's performance obligation. So that's how you account for a multiple element arrangement. And now let's go through kind of an interesting example of Apple's iPhone. The iPhone is a multiple element arrangement, and here's how. So here's the iPhone. When you buy that, you're not just expecting to buy a device. You're expecting that device to have software on it, and for that software to keep up with the times. And so not only is Apple giving you the device, but they're also promising you certain updates and support while you're using that device. So the elements are of the iPhone. First, the device, that's the obvious one. That's the thing that they give you and you go home with it. But the other element in this arrangement is future updates and support. So these are the two elements of the Apple iPhone. And what Apple does is they'll take the total selling price of the iPhone, and that used to be $650. Step one was to identify the different elements. Step two, remember, is to allocate the total selling price among the elements. So we need to allocate that $650 to these elements. And how Apple does this, first of all, how they're supposed to do it is first ask themselves, do we know the standalone selling price for any of these elements? And the answer is no for Apple. They don't sell a standalone device. The only experience they have is selling a device that comes with updates and support. So they don't actually know the standalone price of selling the device. They also don't sell updates and support as a standalone product. So they'll need to just estimate how much of the selling price goes to updates and support and how much goes to the device. And here's what they came up with. They came up with $25 going to the updates and support, and therefore, how much is going to the device? The remainder, $625. So now we've done this step two where you allocate the selling price among the deliverables. Next, you identify the performance obligation for each element. So when does Apple earn the revenue associated with the device? Well, they earn that immediately. As soon as they hand you the device and you get to go home with it, they've earned it. That's their performance obligation. The updates and support is a little different. They promise to provide you updates and support into the future, and so they can't recognize that revenue right away. This requires actually another estimate, and they ask themselves, how long is the customer going to need updates and support on this phone that they're buying? And their current estimate is around 2 years. So they think they earn this revenue over 2 years because they figure after 2 years is over, you ditch your iPhone and buy a new one. So they're going to assume that they earn this $25 updates and support revenue over 2 years. So let's see how this plays out with the journal entries. At the time of the sale, Apple sells you the iPhone for $650. Here's the journal entry they make. A debit to cash of $650. And right at the time of the sale, they've earned the device revenue. So they can credit revenue for $625. That's the amount they've earned. The amount they have not yet earned is the $25 updates and support. And so they stick that into the deferred revenue liability account. That's what they record at the time of the sale. Now let's talk about after 1 year goes by. So over the course of that year, what have they been doing? Well, they've been providing you updates and support. And so they've earned exactly half of that deferred revenue because they're assuming they're going to be providing you that service for 2 years. So after 1 year goes by, they're going to earn half of that revenue. Here's how they do it. They debit deferred revenue, taking it out of deferred revenue, and credit revenue, putting that revenue onto the income statement. So that's the journal entry they record to recognize some of that deferred revenue. After 1 year, after year 2, another year has gone by, they recognize the remaining $12.50. So if you look at all of the journal entries put together, how much total has Apple charged to revenue? Well, $12.50 plus $12.50 is $25, plus $6.25. They've recognized a total of $650, which is the total selling price. It's just that the different elements had different performance obligations, so they couldn't recognize all the revenue at once. And so there's how Apple accounts for the iPhone. Now finally, what I want to do is show you something a little interesting, and I want to emphasize the point that this involves management estimation. And those estimates can change. So let me show you what happened in 2015. And this is from Apple's Form 10K. And many people when they're reading a 10K, maybe you'll find your way to the Management Discussion and Analysis, the MD&A. Maybe you'll find your way to the financial statements. But it's more rare for readers of the 10K to make it to the footnotes below the financial statements. So this little statement was made in the revenue recognition footnote of the financial statements. And let me just read it for you. Here's what Apple says. Beginning in September 2015, the company reduced the combined ESPs. Now, ESP stands for Estimated Selling Price. Remember, they estimate what is the selling price of the updates and support. So the company reduced the combined ESPs for iOS devices and Mac between $5 and $10 to reflect the increase in competitive offers for similar products at little or no cost for users, which reduces the amount the company could reasonably charge for the deliverables on a standalone basis. What is this paragraph saying? This paragraph is saying that those updates and support, well, those users can acquire that at little or no cost. And so they're going to reduce the value of those updates and support between $5 and $10. So in simple terms, here's what they're saying. You know how we used to think updates and support are worth $25? Well, it's not that valuable. We don't think it's worth $25 anymore. And for the purposes of this lecture, I'm just going to assume that they reduced the estimated selling price by $10. So they're going to say the updates and support are not worth $25, they're worth $15. Let's see what effect that has on Apple's revenue. So here's the original journal entries that we did before the accounting change. Now let's see what the new journal entries would be after the accounting change. So at the time of the sale, they're still receiving cash of $650. But now, instead of recognizing $625 only for the device, they're recognizing $635 because those updates and support are less valuable. They're only $15, where they used to be $25. Okay? So you can see here we're only sticking $15 into deferred revenue. Then after a year goes by, well, now we take half of 15, and we, as Apple, recognize $7.50 after 1 year goes by, and another $7.50 after another year goes by. So you can kind of see here that they're recognizing more revenue up front and less revenue later on. So here's a graphical representation of what Apple's doing. Here's what they used to recognize, $625 up front and $25 later. So revenue now, $625. Revenue later, $25. That's what they used to do. And what I'm telling you is that when Apple made this change, they're essentially stealing revenue away from the future so that they can recognize it immediately. So they stole this $10 of revenue away from the future, and they recognize it immediately today. They're pulling revenue into the current period. As an investor, you want to make sure not to be misled by this change in estimate. You might observe an increase in revenue in the current period, and you want to be careful whether you are attributing that to an increase in iPhone sales, an increase in the selling price, the total selling price, or is this increase related to this change in estimate, where we're just increasing the selling price of the device, but we're not actually receiving more cash from our customers. So that's why it's important to be aware of the effect of estimates on these financial statements. Is this a significant deal? I mean, this is only $10, right? We're taking $10 per iPhone. Is that a big deal? Well, here's the Q4 2015 number of units that they sold. So in Q4 of 2015, they sold 48 million iPhones. So multiply that number by $5 or $10, and you can see that the effect that stealing $10 per iPhone from the future can have on current period revenue. But just know that, if you're goosing current period revenue, what is going to be the effect on future revenue? Well, you're stealing revenue away from the future. So revenue is going to take a harder crash in the future. Finally, let's look at just how investors responded to this announcement. So Apple announced their earnings for Q4 of 2015. Investors saw the income statement, saw the balance sheet, saw the cash flow statement, and reacted to it. So what I'm going to show you now is a Factset summary of Apple's earnings announcement for this period, so the 2015 period. And here this is just Factset as an investor data service, and they provide information about earnings announcement and other things. And so here's a little summary of Apple's Q4 earnings announcement for 2015. They say Apple reports Q4 EPS of $1.96. That's $1.96 per share. And they say versus Factset of $1.88. Now, versus Factset, that means what were analysts expecting EPS to be for Q4 of 2015. Analysts were expecting $1.88. Apple reported $1.96, so Apple exceeded expectations for earnings in this quarter. And here's some detail about the announcement. So here they have revenue, and Apple reported revenue of $51.5 billion versus Factset, which is analyst estimates, of $50.99 billion. So they just barely met expectations in terms of revenue. They just barely beat expectations in terms of how much revenue did they get this period. They also have a gross margin analysis here, but also I want to show you the shipments. So shipments refers to the actual number of products that were shipped or sold. How did that do compared to expectations? Well, the iPhone they sold, remember, 48.05 million iPhones. That's how many iPhones they sold in the fourth quarter. The consensus, or analysts' estimates, were 48.13. So they actually didn't sell as many iPhones as analysts were expecting them to. For Macs, they just very slightly beat expectations in terms of their Mac computers. And for iPads, they pretty healthily missed the expectations for selling iPads. So it's not great. I would say this is not great news in terms of unit sales relative to expectations. But what's interesting is even though they didn't sell as many units as expected, they beat expectations in terms of revenue recognized on the income statement. So that's a little hint that maybe the number of units isn't being faithfully represented by the revenue figure. And one explanation for that could be that even though they didn't sell very many units, for each unit they stole $10 of revenue away from the future and put it in this Q4 2015 earnings announcement. So that's a little interesting example of how a multiple element arrangement is executed, how it's done, and how important it is to be aware that many of these complicated accounting treatments require management to make judgments and estimates, and the sometimes significant effect that can have on the financial statements.